Hello, hello. You guys can hear me over there? All right. Thank you guys for being the brave ones. So first of all, a little bit about me. So my name is Joao Reginatto. I've been in the stablecoin world for over 6 years at this stage. I used to work for Circle for 8 years, and in August last year, I joined M0 Labs. And at Circle, I led the build out of USDC and led the product teams around stablecoin and all the products involved in it, not only USDC, but also Eurocoin and the cross-chain transport protocol product that was built as well. So I have a little bit of history, and I have a passion in particular about interoperability because I always come to stablecoins from the perspective of them being infrastructure a lot more than a retail product that people are aware of it. I think that's just the tip of the iceberg. And since we live in a world that is completely non-interoperable when it comes to stablecoins today, I'll talk a little bit about what we're doing at M0 in an attempt to improve them. So first of all, there you go. First of all, let's look at the market as it is right now and think about the dynamics a little bit. I think again, this is not news for you all, I'm sure. But this is the data as it's taken from this morning. So, and I'm looking here at really only the dollar-denominated stablecoins that are backed by fiat collateral, right? So off-chain collateral. I'm discounting everything here that's based on crypto collateral, whether they are endogenous or not. We qualify those as a little bit more experimental. These products are pretty robust. They're pretty established. But the picture of the world that we have today is a world that is very, very highly concentrated in the hands of USDT, as you can see. And if you consider just the top two issuers between Tether and Circle, they hold over 95% of the market share. What are some of the characteristics of the market today? So it's about 130 billion in size. Again, discounting sort of the crypto native stablecoins, which add about another 10 billion to it. It is reasonably fragmented, so there's actually 22 live products today as far as, again, off-chain collateralized dollar-denominated stablecoins. But it's highly concentrated, so despite there being 22 live products, the vast majority of the market is taken by just the top two issuers, and even more if you consider the top three issuers then. All of these models are what we call single issuer models. So they're very centralized. They're not, they don't align with the ethos of blockchain and crypto at all. And we're going to talk about why that is not. And I'm part of the problem, right? I helped create the second largest, but I recognize that is an issue that needs to be improved on, and we're going to talk about that. My opinion is that these products actually have little to no differentiation. You know, despite what the issuers might argue, there's very little that differentiates them. It's like, oh, you can trust me a little bit more, or you know, my licensing regime is different. Like, that's not really a different. Like, these products are effectively commoditized, very similar in nature. If you consider like the technical layer that they have, it's very simple and very much the same. They do have strong network effects, though. They behave a lot like payment rails from that perspective. So in the sense that, you know, if I'm using PayPal and I have the power to tell somebody to pay me using that payment rail, that has strong network effects because it kind of connects this network that uses the same payment rail together. And it's very interesting from a business model point of view because these issuers in these models, they don't really generate any utility. Utility from the point of view of, and maybe I'm being too rough, don't generate any utility. They generate some residual utility, but the majority of the utility is generated by use case venues. So a centralized crypto exchange, for example, a DeFi protocol, this is where the utility is for those products. But the issuers sit outside of those utilities, and they keep basically 100% of the upside, whilst the use case venue is generating all of the value really in the sense that it is accumulating all of the customer deposits, but it's keeping none of the upside. And despite, you know, some reasonably high barriers for entry from the perspective of what it takes to build one of these centralized issuers, but also what it takes to break into the network effects, there are a lot of new entrants coming. So if we have about 22 live products today, we're going to have a lot more in the coming months because there's a lot of companies coming to market. And we think that's a reflection of the famous quote by Jeff Bezos, your margin is my opportunity. The business for decentralized issuers is too juicy for you not to see competition in the near future. Let's think critically about this market and its structure. When you zoom it out a bit and ignore crypto versus traditional finance, and think about structures that have been in place a lot longer, so before blockchain, before crypto, what lessons can we learn from that? I think the first one is that tokenization is not necessarily a new thing, right? If you assume that e-money issuance is also some form of tokenization, is also taking a form of money from a counterparty and issue an electronic instrument on top of that. In a way, that is tokenization, that has existed for many, many decades around the world in different ways. Obviously, issuing these instruments on a blockchain is kind of the novel element, but is not as innovative as some people claim to be, particularly in the way that these products have been architected. The other thing that we can think about is what are the equivalent to these stablecoin issuers in traditional markets? So what is a Circle? What is a Tether in traditional markets? Are those e-money issuers? So is PayPal an equivalent? Is Square Cash an equivalent? Is Starbucks an equivalent? I mean, Starbucks, if they're dollar balance product that I'm sure most of you use to buy a cup of coffee, if that was issuing an electronic instrument that was available on a blockchain and people decided to call that a stablecoin, it would probably be the fourth or the third largest stablecoin comparably. So are those equivalent to stablecoin issuers? Are banks equivalent to stablecoin issuers? Are what banks do in the form of issuing deposits equivalent to what these stablecoin issuers are doing? Are payment rails equivalent, right? So is an ACH, is a SWIFT and Fedwire equivalent to stablecoin issuers? I think the answer is not really yes and not really no for any of these. Stablecoin issuers are kind of a novel thing that was invented, but also a little bit of a weird animal because it is novel. And I think what we will talk about later is that the market is evolving for that novelty to go away and for us to go back into more traditional business models. Because if you think about it, what is the typical business model of these traditional constructs and what is the technology stack of these traditional constructs? It's a lot more sophisticated, a lot more complicated, and a lot more valuable than what stablecoin issuers as they are today are. So let's talk a little bit more about interoperability in particular then. This is not, obviously we don't have time to do a lot of history discussion here, but historically, for a couple of hundreds of years already, we have grown accustomed to, despite some people, especially on policy and regulatory elements, enjoying that or not. But the vast majority of the money that we use today is issued privately, right? It's called private money. Cash, for example, which is something that is issued directly by governments, is actually a very small part of what we use on a day-to-day basis. I mean, the money that you have on your bank accounts, the money that you have on digital wallet products, those are all issued privately. And the way that this started, particularly if you want to think about the U.S., is in the form of commercial banks, the narrow banks, the cowboys of the time, issuing their own instruments to behave like money, so the early IOUs, and issuing those deposits in a way that was somewhat structured and over time somewhat similar. But it was highly fragmented. So you have all these banks, they're issuing their own private version of money. They're not interoperable, right? So if you're dealing with a bank in Arkansas versus a bank in Texas, like they are completely different and they don't interoperate. You're going to have to trade effectively one instrument for another. And obviously, as the economies around the world evolved, like this proved to be an extremely limited model, right? It's obviously bad for you to have a very fragmented version of money in a society. It's going to be on the way of economic growth and activity growth. So eventually, if you want to consider that a technology stack, it has evolved around the issuance of private money to include things like central banking, to include things like clearing houses, and et cetera. And so all of a sudden, there was a lot more standards around it. There was a lot more sophistication around how these instruments should be issued, how they should be governed, and how they should interoperate. And if you think then, today, the way the banking system works, most of the time around the world, you continue to have all these versions of private money being issued. I mean, effectively, when you have money at JP Morgan Chase, it is not the same money that you have if you have a deposit on Bank of America, right? And a good example to illustrate that is about a year ago, if you had dollars on Silicon Valley Bank, were those dollars effectively the same as dollars that you had on Wells Fargo? No, they were not the same because they were about to disappear for a while, right? So, so privately issued money still exists today. The difference is that we just have better technology stack, I would argue, in traditional markets than what we have in stablecoin markets today. In terms of governance, in terms of ensuring interoperability, the technology stack is more robust and is more sophisticated. And the reason why we're talking about this is effectively to illustrate that we need to go through that exercise in history in stablecoin, in the stablecoin sector as well. Because if we think about stablecoin interoperability for a second, these products are definitely not interoperable. This is an argument that I have sometimes with people, and people say, no, but I can trade, between USDC and USDT. Yeah, but trading is not really interoperability, right? I mean, if I send you an email from my Gmail account to your Yahoo account, and you lose like a couple of characters at the end, in like as title of, the cost of interoperability, is that really interoperability? No, there's no standard. There's maybe an underlying standard in things like the blockchain asset standards like ERC20, but there's no standard at the stablecoin level. And users have to really go through a price discovery exercise to convert from one form of these guys to another form. So if I have USDT and I want to get to USDC on the other side, I effectively have to trade one for the other. And that involves price discovery, involves going to a market, and involves somebody assigning, ascribing value and price to my assets. And if you want to create a new stablecoin issuer, like it just has a lot of barriers for entry, at least in the way that people have thought about it. Because people have thought about it, okay, I'm just going to copy this model and I'm going to create my stablecoin, and my stablecoin is going to be incrementally better. But for me to have a business, I actually need to gain acceptance and adoption of that. And so people need to recreate all the set of use cases, push for traction, push for trading liquidity. And effectively, this leads to market fragmentation. Like what I'm advocating is that people got to stop doing that. Like, please stop issuing new stable coins if they're completely fragmented and not interoperable. First of all, you're unlikely to win because the difficulty of breaking into the network effects of something like USDC and never mind Tether is enormous. But most importantly, because you don't have to do that. Why do you have to care about use cases all around the world? I'm going to propose a different strategy here. And obviously, everything that leads to market fragmentation is going to be objected by market participants. Market fragmentation is essentially bad in most of the time. And the counterforce to that effectively is market concentration. So it's what I said. Effectively, we have 22 live products. But in a sense, the top 2 products have 96% of market share. And just for you guys to think about a quick case study here, what Binance did with BUSD in 2022 and 2023 is actually really, really interesting. And we believe that it is actually the way that the market should evolve. So Binance, if you think about it, had a self-branded dollar product. It was recognizable within its ecosystem of services, right? There was a lot of synergies. For example, you got free trading on Binance if you used BUSD as opposed to some other product. They implemented over time this seamless auto conversion process, right? So if I deposited Tether, I would have a dollar balance on Binance, and behind the scenes, they would actually auto convert that Tether that I deposited into BUSD. Again, moving a little bit away from this idea that stablecoin are retail products that customers actually have a choice and they say, no, I'm going to hold this thing on my wallet and not the other thing because I like this color better than the other. That is a false prerogative. The reality is that you're going to use services, and whatever that service tells you to do, you're going to do it. And so it is the prerogative of a service like Binance to completely auto-convert all of these deposits into whatever form of dollar is better for them, which in their case was BUSD, because they would make the treasury yield on top of 100% of the customer deposits, which is precisely what a rational company should optimize for, right? They own the business model, and they didn't need to push adoption into other venues. So think about it. BUSD was completely irrelevant outside of Binance. Nobody cared about BUSD outside of Binance. Probably nobody cared about BUSD period, unless they were using Binance services. And again, why should it be different? Why should Chase go to Bank of America knocking on the door and saying, you should definitely use my dollar infrastructure? Like, it doesn't make any sense. These venues should be completely independent. So let's talk about what we do at M0 then. What is M0? M0 is, and I should say it will be, because it's in the process of launching in a couple of months, but it will be an on-chain protocol combined with a set of off-chain standards and APIs that effectively allows multiple institutions to issue a fungible crypto dollar. In our case, we call it M. So effectively is turning the infrastructure of stablecoins upside down and acknowledging a certain belief system. So this is what we believe in, that money issuance infrastructure should be democratized. So if you think about it, there's no way today for me to knock on Tether's door, to knock on Circle's door and say, I would like to issue your product as well, can I? There's no, first of all, they're going to tell you no, but second of all, there's no construct for that. While in traditional markets, is there a way for me to become a new bank? Hell yeah, it's pretty well understood. Is there a way for me to become a new e-money issuer? Hell yeah, very well understood, very large markets. So it's not tenable, it's not practical, particularly in crypto and blockchain as an industry where the ethos is so different, for us to say that, you know, there should be these ivory tower, you know, dollar product issuers, and nobody should touch them. That's wrong, and we think this infrastructure should be democratized and available for any institution. The other thing is every use case venue should become their own issuer. That's something that we believe in. Every centralized exchange that has digital dollar customer deposits, pardon the word, but they're stupid if they're not issuing their own stablecoin. They're losing money. They're hemorrhaging money every day to these large issuers, and there's no reason why they shouldn't issue their own stablecoin. The problem is that people have understood this in the past in the wrong way. They think about it as, oh, I'm going to have to issue my stablecoin and then spend a lot of time and money going around and gaining adoption. And our answer is no, you don't need to do that. Just focus on your own business. Do you have a small exchange that has $200 million in customer deposits worth of stablecoin? Create your own stablecoin and auto-convert all of that into your own and make 5% on top of that. The other belief that we have is that reserve and collateral quality should be standard, should be pristine. Obviously, this is the most important thing for these products, but it should be standard. Enough of this thing of, you know, my money market fund is better than your treasuries, and, you know, your partner for holding treasuries is worse than this other one that I got, and, you know, your jurisdiction is worse than mine. This is all like childish. This securitization, you know, proper custody of collateral has been done for decades. And like, I think in crypto, sometimes we have to relearn what has been done for decades in traditional markets. Like, there's no reason to innovate in this. Like, you just find like a standard securitization, like orphan special purpose vehicle in some very, very sound jurisdictions. You collateralize a stablecoin with US Treasuries, short term probably, and off you go. Like, you don't need to argue with anybody that that's good or not, because that has been proven to be good for years and years and years. The other belief system is that interoperability should be an ecosystem-wide goal. I'm very disappointed that we as a stablecoin ecosystem are not rowing behind and arguing more about this. I think you know, people say, oh, look, you know, it's the killer use case in crypto. Look at how much traction we have gotten with dollar stablecoins, and that is true. But we have landed on a very, very bad spot today. We have landed on a spot where a single issuer has 75% of the market. There's no interoperability with anything else. Just think again, zoom out and think about traditional markets. Would we be okay in any jurisdiction with a bank that holds 75% of customer deposits in that jurisdiction? No, that's an extremely bad from a concentration risk. Like, regulators would intervene like much earlier than that, and we got to think about that. The lack of interoperability is really bad for consumers and for all the venues that utilize these products. And effectively, we have put these products, you know, as czars, as like dictators in an ecosystem that, from an ethos point of view, should be a lot more decentralized and open. And the other belief that we have is that the business model for stablecoin issuers, in the absence of utility services, will come to an end. So somebody who is just a stablecoin issuer, period, and they don't do anything else, they don't create any utility for that product, that's going to come to an end pretty quickly, we believe. So very quickly, the way that M0 works is that it outlines a couple of specific actors that participate in a coordination system. There is eligible collateral that, from a governance point of view, there's criteria dictating what is eligible collateral. And imagine, in this case, short-term U.S. Treasuries to begin with, that gets allocated and custodied in collateral storage mechanisms that, again, are very, very pristine, but very standard. Not a lot of innovation there. But they are separate from the issuer. So imagine that more similar to banks, this collateral is actually injected almost like equity from third-party providers. It's not the deposits that's coming from customers. You have issuers. You have an external type of entity called a validator that verifies that this collateral is in place and emits proof of reserves on chain. And then that issuance, of the stablecoin gets sent into the market and gets traded into the market. So this is effectively how it works. We are very interested in discussing with folks that are interested in becoming validators, issuers, supporting collateral storage. We're open for business and interested in discussing with folks who are passionate about stablecoins. You can find some contact details, and thanks for the time.